Here's a question your bank doesn't want you to ask out loud. Why does the banking system look at a person with $2,000 in their account and see a customer, but look at a person with $20,000 and see a threat? Same person, same job, same neighborhood. The only thing that changed is one extra zero. The truth is, the financial system isn't designed to make you rich. It's not even designed to make you broke. It's designed to keep you something far more profitable. Comfortably broke. By design. Wealthy enough to keep showing up to work on Monday, poor enough that you'll never stop being a source of interest revenue. And there's one specific number, one tipping point, where the entire game flips, where you stop being prey and start being a problem. That number is $20,000. Let me show you the real math. When you have $2,000 in checking, you're not a client of the bank, you're inventory. Here's the math nobody runs for you. The average American with under $5,000 in savings pays roughly $300 a year in bank fees alone. That's 15% of a $2,000 balance gone every single year before inflation even gets its turn. But the fees are just the appetizer. The real meal is what I call the logo tax. The logo tax is the premium you pay not for the product, but for the feeling of not being broke. The Starbucks instead of the home brew, the new car instead of the reliable used one, the brand name sneakers instead of the generic. And the bank loves the logo tax because it almost always comes with its evil twin, the EMI trap. EMI, equitated monthly installments. The $499 a month car, the $89 a month couch, the $40 a month phone. Each one feels affordable. Each one is a leash. Because here's what the bank knows that you don't. When your monthly obligations equal 90% of your income, you don't own your salary anymore. The bank does. You're just the courier who delivers it. This is the salary treadmill. You run faster every year, raises, promotions, side hustles, and somehow the finish line moves with you. That's not an accident. That's the product. So why $20,000? Why not $15,000? Why not $50,000? Because $20,000 is the first number where the rules of money flip. Below $20,000, money is reactive. Every dollar you earn has a job before it lands in your account. Rent, gas, groceries, the minimum payment. You're not managing money, you're triaging it. But at $20,000, something changes. For the first time in your adult life, you have what I call option money. Option money isn't about being rich, it's about being unreachable. It's the cushion that lets you walk out of a toxic job on a Tuesday without negotiating with your landlord on Wednesday. It's the buffer that lets you say no to the 24% APR personal loan when your transmission dies because you can just pay for the transmission. It's the silence that lets you sleep through a bad month at work without spiraling into a panic-induced Amazon binge. $20,000 is the first financial shield large enough to deflect the system's three favorite weapons against you: desperation, urgency, and shame. And that's exactly why the bank views you differently now, because a person with $20,000 in cash is a person who can wait, and the entire consumer credit industry is built on customers who cannot wait. Here's the shift nobody explains in school. Before $20,000, you play defense. Every dollar you earn goes toward keeping something bad from happening: a late fee, an eviction, a repo, a credit hit. You're not managing money, you're blocking. After $20,000, you start playing offense. For the first time, your money earns its own money. A 5% high-yield savings account on $20,000 throws off $1,000 a year for doing absolutely nothing. That's a car insurance policy. That's 2 months of groceries. That's a plane ticket, earned while you slept. This is where the snowball effect finally becomes visible. Not theoretical, visible. You can watch it, you can feel it. And the bank suddenly can't reach you the way it used to. No more overdrafts, no more minimum balance penalties, no more emergency credit card swipes at 26% interest. The bank's most reliable revenue stream, you, is gone dry. That's why $20,000 isn't just a savings milestone, it's a declaration of independence. Now here's where it gets interesting. The most dangerous person to the banking system isn't the loud millionaire on Instagram. It's the quiet neighbor in the Honda Civic who has 6 figures in index funds and nobody knows it. This is stealth wealth. It's the practice of having the money but refusing to perform having the money. Because here's the trap most people fall into right at the $20,000 mark. They upgrade. They feel rich for the first time, so they buy the car, the watch, the apartment, the vacation. And within 18 months, that hard-won shield evaporates back into the bank's vault through EMIs, lifestyle creep, and what economists politely call social taxes. Lifestyle creep is the bank's favorite weapon because you deploy it on yourself, voluntarily. The stealth wealth practitioner does the opposite. They cross $20,000 and nothing changes. Same car, same apartment, same wardrobe, same coffee at home. They've made a quiet psychological switch that almost nobody talks about. They stopped being a consumer. They became an owner. A consumer asks, what can I buy with this? An owner asks, what can this buy for me? A consumer sees $20,000 and thinks down payment on a car. An owner sees $20,000 and thinks a machine that prints $1,000 a year forever. That mental flip from spender to allocator, from performer to accumulator, from customer to threat, that is the quiet escape. And it's the part the system genuinely cannot stop because it happens entirely inside your head. Here's what nobody tells you about $20,000. It's not the destination, it's the trailhead. Because once you cross it, a second tipping point reveals itself, one that's even more powerful and even more hidden. It's the point where your money starts earning more than your labor. The point where your snowball isn't just rolling, it's avalanching. Most people will never see that second tipping point, not because they can't reach it, but because they spent their first $20,000 trying to look like the kind of person who has $20,000. You won't make that mistake. So, here's what I want you to remember. $2,000 makes you a customer. $20,000 makes you a threat. And the people who understand the difference are the ones the system never gets back. In the next video, I'm going to show you the second tipping point, the number where your money officially starts working harder than you do, and why most people miss it by trying to skip $20,000 entirely. Hit subscribe because you don't want the bank to know what you just learned.